Hey, good afternoon, everybody. It's Arion with Investing Architect. We're having such gorgeous weather here in Houston this Friday that I'm trying to spend as much time outdoors as I possibly can. By the way, this is our winter weather. I got in a great run this morning, and now I decided to come for a little walk in the neighborhood behind my office building. And I thought it'd be a good idea to shoot a quick video on the tax benefits of owning investment real estate. Now, many people are aware that as a general concept that real estate offers tax benefits, and owning a rental property could help you save money on taxes or lower your tax liability. But most people that I talk to aren't quite sure on what those benefits are and how they actually help you and how they work. So the way I was planning on doing this is in two parts. In today's video, I'm going to cover the two fundamental tax benefits that are available to real estate investors. And then in a subsequent video, I was planning on doing some more next level advanced tax strategies that real estate investors can use. So the two fundamental tax benefits that are available to owners of investment real estate are depreciation and like-kind or 1031 exchanges. So let's take them one at a time. So depreciation, in effect, is the IRS allowing real estate investors to keep two sets of books. On one hand, you have reality and that set of books, which is here's how much income came in, here's what the actual real expenses were, here's how much cash flow is left over, and that's the real income. But on the next set of books, the IRS allows real estate investors to depreciate the value of the improvements, meaning the value of the building, over a either a 27.5-year or 39-year schedule, whether the property is residential, meaning single family, duplex, triplex, fourplex, or multifamily, which is considered all residential, or commercial, so shopping centers, industrial, and so on, have the longer 39-year schedule. So essentially what the IRS is saying is that the improvements or the buildings in your property are getting worn down and depreciating every year. So effectively what they're doing is they're allowing you to depreciate an asset that is appreciating. So let me say that again. They're allowing you to depreciate or take a deduction on an asset that's appreciating in value. Now, if that's not the best thing since sliced bread, I don't know what is. But, us real estate investors will take that benefit as long as we can. So the way it works then is in the second set of books, the IRS says you get to take this deduction for depreciation, which can result in either, if you've got a really highly cash flowing property, it can result in you paying taxes on a smaller amount of income than what the real income was. In some cases, it can take a property who is cash flowing and make it show or show like it is breaking even. And in some other cases, it can produce what's called a paper loss, meaning on paper you lost money, but in reality you made a little or you had a profit. So this benefit is only available to real estate as an asset class. Like you can't depreciate your stocks or you can't depreciate any other investment assets like this in this manner. So that's a significant benefit that lowers that the IRS is essentially trying to encourage people to purchase investment real estate, and that's why they're offering this benefit, this tax benefit, to incentivize that behavior that they want to encourage. The second fundamental benefit, tax benefit of owning investment real estate are like-kind exchanges. So let's say that you own a piece of property and you bought it at a good time, at a good price, and you held it for 10 years, you rented it out, it was a good property for you, and then you realize that, okay, the time has come for you to sell it. If you sell it, the gain between what you paid and between what you paid and what you sold it for, it's usually taxable. It's called a capital gain. But the IRS allows you to essentially transfer that gain and defer the taxes on that gain by simply not touching the proceeds of the sale and then transferring that gain into a like-kind or another investment real estate that is at least of equal value. So essentially, you could sell a rental property and buy another rental property of equal value, and you would basically defer all of the taxes on that sale. So what this allows you to do is it leaves your investment dollars in the investment, right? It allows them to keep compounding for you rather than them going to Uncle Sam. And I like I say, I always prefer the dollars in my assets and in my properties rather than in Uncle Sam's pockets. So this ability for you to transfer the gain and to not interrupt the compounding process unnecessarily, as Charlie Munger would say, is a huge benefit because it allows you to transfer that gain and defer the taxes. So those are the two fundamental tax benefits that are available to investors who own investment real estate. And then in the next video, I'm going to cover some advanced next level strategies that are available to real estate investors. I hope this was helpful for you. I hope you have a great weekend, and thanks for watching.